This webinar will start shortly. Hello, welcome to the Estate Gift and Generation Skipping Tax Law changes with regard to the Tax Cuts and Jobs Act, part of Bedel Financial's webinar series. My name is Kathy Hauer. I'm the Director of Financial Planning and Senior Wealth Advisor with Bedel Financial. One of the most significant changes that was made with regard to the Estate Gift and Generation Skipping Tax Law is that of the federal exemption amount or unified credit. This amount is the amount of assets that you can transfer on to the next generation without incurring a federal estate tax. In 2017, that amount was $5,490,000. Today, it's increased to $11.2 million per individual. This amount is scheduled to increase annually and will expire after the year 2025. Any amount that's transferred to others exceeding the $11.2 million would be taxed at a rate of 40%. The federal exemption amount that married couples can transfer on to the next generation without incurring a federal estate tax is twice that of individuals. It is $22.4 million. Any gifts to a qualifying charity during lifetime or at death would not be subject to the gift or estate tax. Keep in mind that some states still impose estate death tax on wealth transfers at death. It's important to understand what your state's estate tax laws are in order to plan accordingly. The Portability Rule is fairly new and was kept in the new tax bill. This allows a surviving spouse to utilize a deceased spouse's unused credit with proper planning. An example is outlined here where we have a married couple, John and Sally, who have a $25 million estate. John has $10 million of assets in his name and Sally has $15 million in hers. Let's assume that John passes away this year and transfers his $10 million on to he and Sally's children. With the $10 million transfer, he has $1.2 million of unused credit on the table. That's the $11.2 million exemption limit less the $10 million that was actually transferred. With this, Sally can opt to utilize the unused $1.2 million to further minimize taxes at her death. Thus, she could transfer $12.4 million onto their children without incurring any tax. The amount over $12.4 million would be taxed at 40%. The step up in cost basis remains in the new tax bill. Let's assume that Grandpa bought 200 shares of stock for a total purchase price of $20,000 back in 1995. Grandpa passed away today, and now the value of those shares is worth $250,000. The individual who inherits those shares of stock would receive those shares with a cost basis of $250,000 versus the $20,000 that Grandpa purchased them for years ago. This is very advantageous, as if the individual who inherits the shares wants to sell them, they likely would not have to pay a capital gain tax, as there would be little to no appreciation on those shares after received from his grandfather's estate. This slide indicates the new tax brackets for trusts and estates. On the left, you'll see the tax brackets under the old law, which consisted of 5 different tax rates from 15% on up to 39.6. Today, there are 4 tax brackets ranging from 10% on up to a top rate of 37%. It's important to note that the amount of income that is subject to that 37% tax rate today is $12,501 and up. That's not a lot of income taxed at that high tax rate. Thank you for listening to my webinar. I hope it was helpful. I hope you also have the opportunity to listen to Bedel Financial's additional webinars with regard to the Tax Cuts and Jobs Act.